Bank of Canada announcement today. They are going to keep rates exactly where they are for at least another month and a bit, 2 months. Next meeting is at the end of July, where we will see 25 basis points off of the prime rate. But until then, we're going to have to wait. This was an announcement that was really highly based upon tariffs in both directions, frankly. Tariffs make an argument for why the Bank of Canada probably should have cut interest rates today, because it's going to affect, it is already affecting and will continue to affect our unemployment numbers. However, tariffs are causing inflation to come into the Canadian economy. We're seeing our CPI numbers, our core CPI numbers, the ones that the Bank of Canada really likes to look at. We're seeing those a little higher than where the Bank of Canada needs. In fact, anecdotally, we've never seen the Bank of Canada reduce interest rates in an environment where core CPI was as high as it is right now. I also think that we're in somewhat unprecedented times, and that the negative impact of these tariffs and everything that's happening in the Canadian economy would have been a very strong argument for us to decrease interest rates, considering just how weak that unemployment number is and how weak the Canadian economy looks to be continuing to be. I think that if the Bank of Canada hadn't had such a bad response to inflation post-COVID, where they kind of lost the confidence of the Canadian people in dealing with inflation, we probably would have seen a cut today. But the post-COVID response of don't worry, inflation is transitory is going to haunt the Bank of Canada for some time, and obviously had some impact on today's decision. I think that the Bank of Canada will continue to consider everything, most notably the CPI numbers that we are still waiting for, of which we're going to get 2 more before their July 30th next monetary policy announcement. I think in the meantime, they're going to be having a look to see what government spending may come in that will obviously also contribute a little bit to the inflation numbers. They're not going to be worried about GDP, and they did even highlight that in their statement today, that they did see GDP a little bit higher. However, it is understood that the increase in GDP was as a response to the tariffs, people trying to front load and get some goods in or out of the country, and thereby increasing that GDP number. I think we're going to continue to see a very strong argument for cuts because of the weakening economy, because of that unemployment rate. As more Canadians continue to be unemployed, we're going to see more misses on payments, more misses on credit cards and car loans and mortgage payments. And as a result, a continued weakening of consumer sentiment, consumer spending, and thereby a drag on those same CPI numbers that we may be somewhat worried about right now. I think that if you wanted to make an argument for inflation to become more entrenched, you would need to believe that the unemployment number would tighten or the labor market would tighten. And to draw a parallel post-COVID, when the Bank of Canada said that inflation was transitory, the only reason why inflation was not transitory was because the labor market was just so tight. There were so few people unemployed. So when inflation came into the marketplace, the demand for employees created an increase in wages. And when wages increase, inflation becomes more entrenched. But when you see inflation coming in right now, as we do with these increased CPI numbers, with a weak labor market and rising unemployment, it's very difficult for inflation to get sticky because there's lots of workers. So wages won't increase, and that means that inflation won't be sticky as it was post-COVID. If you're a Canadian right now trying to make a decision on a mortgage, it's probably variable. I think what we saw today in the Bank of Canada delaying that 25 basis point cut only furthers the argument for a variable rate mortgage. It just means that the Bank of Canada is willing to see a little more pain in the economy before it drops interest rates. I'm of the belief we're going to see 75 basis points in cuts prior to the end of 2025. And I think you'll be sitting at a lower prime rate for quite some time. I think for at least the next 3 to 5 years, you can really bank on a variable rate mortgage. Fixed rates didn't really move too much off the announcement today. Since about April, we saw Government of Canada bond yields increase about 50 basis points. The announcement today didn't really do much. Maybe they shaved on 5 or 10 basis points off. And that probably is just that same expectation that by not cutting rates right now, we're causing a little more harm to the Canadian economy, meaning lower rates for longer into the short, medium term. So if you're a Canadian, I'm still advocating for a variable rate mortgage. I would have liked to have seen 25 basis point cut today, but I totally understand that the Bank of Canada does not want to appear to be making the same mistake twice, and they might be a little gun shy. That's all. Thank you.